Welcome to Adams-Hansen, Income and Social Security Planning, Chapter 3. Our focus in this presentation is on income tax related to your Social Security income. It's primarily for people who can get their income down to roughly $50,000 or $60,000 a year, or for people to create harvesting opportunities to help them defer Social Security beyond 62 or full retirement age. Social Security tax is pretty unique. For starters, it's a tax on something that was once a tax. But with proper planning, there are ways that you can reduce or eliminate the tax that you would be paying on your Social Security benefit. Now, Social Security has 3 tiers of taxation. Some people will pay 0. Some people will pay 50%. Some people will pay 85%. Our goal is to minimize the tax for those people who are able to do so. Now, up to 85% of your benefit may be taxable, depending upon your threshold income. Now, threshold income is your total income plus your non-taxable interest, like municipal bonds, plus 1/2 of your Social Security income. Those things combined equal your threshold income for Social Security tax. So if your threshold income is less than $32,000 when you're married or $25,000 when you're single, you pay no tax on Social Security at all. Only one of you are collecting Social Security and you got $16,000 a year. Only $8,000 of that would count towards your threshold income. That allows you to have $24,000 other dollars before you'd start paying any tax at all on your Social Security. Social Security is taxed at 50% if your income is between $32,000 and $44,000 for married, $25,000 and $34,000 for single. And you get up to 85% once your income gets over $44,000, threshold income that is. And as a single person, it's $34,000. Some period, people just can't get below that number. Or you could only get to that number every other year or every third year by the way you harvest your income. The strategies for reducing tax on your Social Security is really a matter of receiving a less taxable income in any given year. Alternating your years helps in the sense that you could take double the amount of income you need in one year, pay tax on it. The next year, spend that income, pay tax on it, and that could save you $5,000 a year, which may or may not be worth it to you, but if it is, it's worth doing. You can also just change your investments. If you've got investments that pay a lot of dividends or create a lot of ordinary income, you could change those investments to something that pays less dividends or simply defers income until you're going to use it. You can also use non-taxable income as a bridge. In other words, spend cash every once in a while. Spend down the principal of a mutual fund. Find ways to get hands on some of your assets that are not taxable. That way you don't have to pay tax on your Social Security year in and year out. Of course, some of this assumes that you have assets with different tax characteristics. But it's worth it to find out if it's even possible to avoid Social Security tax. Look at what the benefit is to you. At the high end, it's about $5,000. But if you're only earning $50,000 or living on $50,000 a year, that $5,000 is a really big number. And these are a couple of common sense things that you can do to reduce your taxation. You can split variable annuities if you have them. You can split them in half in order to get to principal faster. Take a look at your mutual funds, see if you're holding any losses. Sometimes people are. And if you're getting a whole bunch of dividends or mutual fund income that you're not spending or that you don't need, or consider what your options are to change that. The bottom line is you want to reduce the amount of taxable income you're receiving. That's true whether or not you're trying to defer when you take Social Security or trying to reduce the tax on the Social Security you do take. You can change your investments, you can use non-taxable income as a bridge, and you can alternate years. If any of this is confusing or sounds alien to you, feel free to give us a call. You go through these efforts to reduce the income gap between when you start to retire and when you start to collect Social Security, or the income gap between the amount of money that you need or how much you can take in while still avoiding Social Security tax. Hopefully you've got a spreadsheet created from the previous presentation. Use that spreadsheet to help create a gap report so you can figure out what your income gap is and how to fill it. The next and last presentation in this short series is on fees and how to minimize or avoid them.